Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be taking a look at Veeva Systems stock, ticker VEEV. This one came in by request down in the comments section of one of my other videos. If you have a request you'd like me to take a look at, just put it down in the comments. I'll get the ticker on the whiteboard behind me, and eventually I'll make a video. If it's a stock that's in the S&P 500, I usually post those on YouTube for free. I thought Veeva was in the S&P 500, but when I checked, I didn't see it in there at the last minute. But I was going to go ahead and post this video anyways, and it's going to be a short one. So I'm just going to go ahead and post this one on the YouTube channel. As always, this is not individual investing advice. This is just how I analyze stocks. All right, so let's just get right into this one because I think it's going to be a relatively short video. Veeva is a software company, and they focus on software for like life sciences and biotech industry. They're pretty big at like $33 billion, which is why I thought that they might have been in the S&P 500. And if you look at their earnings history, like it looks pretty good here on the fast graph. I do have a 25% off affiliate link down in the description if you're interested in trying out fast graphs. And you haven't ever tried it before, they have free trials, so make sure to use that link and you can save some money. Okay, but earnings trajectory looks fine. We see that they were in a boom period here when they were trading at 100 PE there during the peak of the boom. Now, I do track this stock in my spreadsheet, but I track it as a potential growth stock. And so what makes this a little tricky is I have certain metrics that I watch that a business needs to be growing by, like a level that they need to be growing by in order to qualify as like a fast growth, kind of more early stage business that has the potential to like 5x or 10x. That's what I look for with my growth strategy. And so I have been tracking this one as a potential purchase there, but the growth metrics actually fell below the minimum threshold for that strategy recently. So if we just look at revenue, I'll just give you one of the metrics. So I want to see like 2-year revenue growth about 45%, and actually 3-year revenue growth is just a little over 40%. And 3-year net income growth is just a little over 40% too. So it's just not growing enough to be considered a fast growth business for me. But it could be a good buy just based on earnings, which is usually the strategy that you guys see me talk about here the most, where I take earnings and earnings growth and I kind of project those out into the future. And I call that the full cycle strategy. Now, unfortunately, we haven't had like a full economic cycle since like 2008. So when I first developed that strategy 6 or 7 years ago, or about 6 years ago, I would go back to about 2006 for most of these stocks. I would see how far earnings fell during the Great Recession. I'd make adjustments for that type of earnings decline if it happened in the future, and I would integrate that into the earnings growth rate that I would use. So, and then for a stock like Veeva Systems, which would have only had like a few years, which only goes back to 2015 data-wise, I would just say, well, there's not enough data, and I just move on. But what's happened is since COVID was a weird recession, and I don't really count it as like a normal like credit cycle type recession, we're just so far away from 2006 or 2007 that I would basically be eliminating, like I wouldn't even buy a stock like Meta or something like that. There's just so many businesses that have gone public in the last 15 years that it became difficult to just like ignore all of them because I didn't have the specific data that I wanted for that strategy. And that's one of the reasons why I developed the growth strategy, the fast growth strategy. But it does, I have to and I do make exceptions sometimes depending on what type of business it is. If I think it's the type of business that I can use another proxy business for to get an idea how cyclical it might be when we do have a recession. So I do have some discrimination there. I don't just you know, make exceptions for every single one for this strategy. But the point I'm trying to get here is I think because if you think of like biotech and like research, the money available for that can be pretty cyclical. And when times get tough, a lot of times these research money, budgets, and so forth can get cut. And so a business that's selling software to the businesses that are having their access to capital. I mean, it's not just research money, but I mean, it's access to capital, how much that money costs, which has to do with interest rates. There's a lot to go into it. But basically, what I'm saying is this could be relatively economically sensitive. And it's trading at, let's see, we're in the 30s PE here. We're at like a 35 PE. So it's not cheap. And the problem that you can get into is since we don't really know how far earnings could fall or slow down during an economic slowdown or a recession, when you start at a 35 PE, even if earnings only fell 10% or something like earnings growth only fell 10%. So instead of growing 10, let's say they dropped 10 in next year. All right. Well, that's probably not going to result in a 20% drop in the stock price. It's probably going to result in a much deeper drawdown because you'll get multiple compression usually from a 35 level, once that earnings growth trajectory starts going down, then people start treating it like less of a growth business, or Wall Street does. It's just usually what happens. So it could easily compress to a 20 PE, maybe even a 15 PE, and that's when you end up being down like 50% or more. Even if the business is pretty good, and even if they eventually recover, it can result in a long period where you don't really earn very much money. Now we've had one of those multiple compressions already because we went from 100 PE to a 35 PE, even though earnings have grown about, let's call it 30, and then we'll call it like 60% or 50%. No, it's more than that. Well, it depends on when we start measuring. Were we here? And it was probably looking forward to here. So 373 going to 6. Yeah, so that's more like an 80% increase in earnings. But what's the increase in price? Well, it didn't increase. The price fell 40%, right? So, and that's all due to this multiple compression. I think if there's a recession, you could have a whole other level of multiple compression. And this happened when earnings were growing 80%. Or have grown 80% and the stock fell 40%, right? So you can see that disconnect can happen. I think it can happen even more if they turn out to be a little bit more economically sensitive and earnings growth slows down or even goes a little bit negative, next year or the year after. And there's enough downside potential, I would say, 50% downside would be pretty easy in that particular situation, that I don't really want to step in when there's a possibility of that. I'd much rather just be patient, keep an eye on the stock. If it does that, and then I can come and reassess, look a little bit deeper into the business and say, okay, let's get down to the nitty gritty and see what would a good growth rate be? What would a reasonable assumption of their growth rate coming out of, a recession or a downturn or whatever be, and then I could try to attach that to it and maybe buy it during one of those downturns when the raw PE is not 35 and more like 20 or 15 or something like that. That's that is the way that I would approach this particular stock. And when you pay too much, let's just go back to here, right? So this was the last time it was at like a high PE, 90 PE. Earnings grew 100% in 2 years, right? And that was back in 2019. So if you would have bought the stock there and held it through today, even though earnings have at least up 300 to 400%, at least 300, you only would have made 16% over that whole time period, or 3% per year, or less than inflation. So that's why you just can't pay too much for these, because even if you're right on the growth, you just went 5 years with basically no return. And you're just sitting on the stock, and if you're trying to make a long-term investment, you really want to buy them when they're cheap, get a little bit of boost because they were cheap if they rise to like fair value, and then get another boost if earnings growth picks up, and then you can kind of hold those for a long time and just get really good returns, even if they just grow at a decent rate after that, right? So that would be the longer term goal on a business like this and a stock like this. And they're not super small either. I mean, 33 billion is a pretty big sized business. So I don't think there's like a ton of reward loss. I mean, you never know when they're going to go through like a boom like this and the market just decides to like it and it doubles or whatever. But you can't really predict when those are going to happen. Or at least I can't. So I try to buy on the other end when I know they're pretty cheap. The reward looks really big, and then if I'm only halfway right, I still do okay. And if I'm wrong, I don't get totally creamed, right? That's kind of the setup that I want. And I feel like right now, this is kind of just, if things go really well, they'll do fine, they'll do okay, but you could also lose 50%. And you're probably not at this point, unless something weird happens, going to make a ton of money at this price. So that's kind of how I think about this stock, big picture and strategically. Now, other people can have different strategies and they have different ways of going about doing things. That's totally fine. But this is exactly how I think about it when I use the strategies that I use, and where it kind of falls into that mix. So I hope that helped everybody. If it did, hit the like button, hit the subscribe button. Go over to Patreon. I have a free tier over there, along with a couple other tiers that I talk about quite a bit on here. But I post all these videos over on Patreon as well, on the free tier. And then on the paid tiers, I post ones that are smaller businesses, not in SP 500 and all that. All right. See everybody later. Bye.